Welcome, I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide insights about the markets, planning, and investing. So today is December 12th, a few days after my birthday, and Jocelyn has a birthday coming up, so this is definitely a busy month for us.
Jocelyn?
Jocelyn's, right?
It's her husband, in case you don't know.
Behind the scenes here doing our audio. And so just an update of where we're at with the markets as of yesterday's close, which is December 11th. The NASDAQ, which reached above 20,000 for the first time, but here we are today, it's down a little bit, so it's not at that peak anymore. But for the year, the NASDAQ was up over 33%. The S&P 500, which is an index a lot of people hear about all the time, as of yesterday's close, it was up over 27%. But once again, we've shared this in the past. The Magnificent Seven stocks represent, as of the middle of mid-year of 24, over 34, almost 35% of the S&P based on the market cap. So once again, even though it's up, a lot of that is really tied to a few stocks. And
so if you just own those 7 stocks, you would have done way better than the S&P 500, right?
Yes, but what goes up can come down, so definitely want to be a little diversified. And then some other news that came out this week is the CPI came out at 2.7, which is the Consumer Price Index. It's a slight increase from October, which came in at 2.6. So it's interesting to see a little bit of a shift, but it also, what we're finding is potentially the interest rate meeting for next week, there is about almost a 95% chance that there's going to be a 25 basis point cut next week. So
I wonder if that's going to stall now, though, because those numbers are still coming in strong.
Yeah.
And until they see more evidence that they're weaker, I'm wondering if the rates are going to kind of stay kind of where they are right now.
Well, we'll see. We have, I think, one more cut, if that, and then I would agree. I think next year we're hearing also potentially it could go back up. So we'll see what happens.
Well, I think the 6 and 9 month T-bills are trading at about 4.30.
Treasury bills?
Mm-hmm.
Treasury bills. And the Fed funds rate is like 4.25, 4.50 is how they say that. If they lowered a quarter, they're down there about in that neighborhood. So maybe that's telling us, like you said, Steve, for the next 6+ months, the market is kind of thinking they're going to be on hold for a while because the inflation data is a little stickier.
Well, the anticipation of the new administration coming in is that the economy will be good. Whether it is or not, we don't know. But if that's the case, then I think that the growth numbers and the that's consumer numbers are going to continue to be fairly high, and there's no real reason to cut rates unless all of a sudden you get a spike in inflation.
Right.
Well, judging, what you said about the CPI was very interesting because, they always exclude food and energy. Mm-hmm. Oh. But food was a huge part of the upside. And the real problem with food inflation is that they pass it on to the consumer. And, the consumer, can get very, very stretched. But you were talking about Fed rate cuts as well. Well, the good thing is monetary easing is always good for equities. And typically when the Fed continues to cut, corporate profits increase the following quarter. And you mentioned a 95% chance that there could be a rate cut. So that's very good. The economic expansion right now seems to be longer. Bull markets are lasting much longer than they were in the past. So that's a good sign. Last 2 years, household incomes have grown dramatically, especially from a wealth standpoint, because the market has done so well. So you do have a stronger consumer. And these are just little points that I've been, kind of looking at over the, past couple of months. Corporate earnings for September quarter. One thing that I did notice was free cash flow was improving for many companies. And judging about your comment last week about multiples in the market, increasing free cash flow does support those higher multiples. So that's why you continue to see the market, kind of move in an upward direction.
So explain what you mean by multiples so the average person out here knows what we're talking about.
The PE multiples are simply,
earnings.
That priced earnings multiple on the market. And it's the same thing on the market. What is the earnings of the overall market and how is the price going to affect that?
So if those multiples go up, that means that there's a higher price.
There's a higher price, but there's also, you have to remember that the valuation valuations then get significantly stretched, and you have to continue to have earnings support that price. And that's why sometimes when it gets a little bit skewed to the upside, you get the big downside move in the market. But right now, earnings seem to be justifying some of the multiples. But there is a kind of a big, bull-bear dogfight going on right now because small and mid caps look more attractive than the overall S&P 500. So, from that standpoint, the bears are saying, hey, the market's going to go down. I don't think.
Wait a minute. They've been saying that now for 2 years.
2.5, 3 years. I understand that. But with the S&P somewhere approximately, 22 times future multiples, they're saying that's quite expensive because on average it should be about 17 to 18.
So going back to it, that's price versus earnings. The multiple
correct.
of that is what you're talking
Correct.
about.
Yes. And you have to remember, earnings drive stock prices, GDP drives corporate earnings, and productivity drives GDP. So all of that is looking pretty healthy right now in the market. And I think the first half of next year is going to be quite good because, you've got a whole bunch of new policies possibly coming in right after January 20th, and the market's going to focus on that.
Well, I think the other thing that the market is really happy about is anticipating less regulation. Mm-hmm. The regulatory environment over the last 4 years has been really, really tough for businesses, especially like mergers and acquisitions. There haven't been a lot of IPOs out there, and it's because of all of the governmental antitrust and regulatory environment that's really been stopping that. So, I mean, we're hoping that's going to be the case. A little less regulation doesn't mean no regulation, okay? It just means that the ominous, what I'll call extra regulation. I know in our business, we have to do things that to me are just busy work, and as obviously somebody who puts these rules into place that, in my opinion, doesn't really know what we do, and I'm sure that's the case with many, many businesses. So the anticipation of less regulations not only is good for the stock market, it's just good for overall innovation. We get in our own way. I was reading something about, I think there was a solar farm that was supposed to be put in, and it would have electrified a lot of different a lot of people, and there was some snail or something that was a rare species. They stopped the whole thing.
Oh, no.
Oh, come on. I get it. Move the snail to another neighborhood. But, this is the problem. So we are getting in our own way. And that's, by the way, one of the reasons why we don't have nuclear, that like other parts of the world are. We're actually falling behind. We've fallen behind. Look at what's going on with the drone stuff in New Jersey. Okay, there are drones coming out every night in formations. Supposedly, we don't know who they are, what they are, which kind of surprises me because I thought that's what the government's job is to try to protect us. But if those drones are in fact really advanced technology, why aren't we on the forefront? Why don't we know what's in there?
I can't imagine that we don't know that there's
Well, why won't the government tell us?
Well.
Good question, right? I know it's more of a rhetorical question.
Yeah.
What they should do is just shoot one down and figure out what's in it.
There you go.
Well, supposedly they're afraid to shoot it down because it's the size of a bus, and they're afraid that if they shoot it down, they're going to cause injury and stuff on the ground. But I think the greater good at this.
Wait till it flies over a field or something, and then shoot it down.
Right. Well, but they're going over strategic assets of our country. So. A lot of people, especially in New Jersey, are pretty nervous about what's going on. But my point wasn't that. My point is that drone technology is the next technology. As a matter of fact, I think that drone technology will be how we fight the next war. Okay? They're going to be able to neutralize ships and planes and everything else with this little drone. So and apparently China is ahead of us in that technology.
Well, we have drone, aircraft, we have drone ships, battleships. I don't know if you call it battleship, but big ships that they are just unmanned that we can send out there now.
I understand, but we're talking about drones in the air that are neutralizing those big ships that you're talking about. So what I'm saying is I think that that's going to be the way wars are fought in the future is if
Kids
it's
sitting
not
in a
already.
room with their little toggle switches.
say
that. Video game.
You know what's funny?
These 16-year-old kids, go get them.
I was reading about, and I wish I could remember the whole thing. I was reading about a woman who got a job, and I believe it's in the government, that had to do with drones, and she got her job because of how good she was in this video game, which wasn't there The Last Starfighter, I think was the name of a movie, that's exactly what it was. The guy was great on the video games, and this guy from outer space says, we need you in our army, in our Air Force, whatever it was.
Yeah.
This is real life.
Being a mother of teenage kids and a teenage boy that likes video games, I firsthand have seen it's pretty interesting how in-depth and technical, and it's pretty fascinating what's out there now with those video games and what you have to do to be a part of that.
My son was on a video game once. This was a long time ago because he's early 20s now, but I was on the other side of the counter in our kitchen and watching him, and I'm filming him with my phone. And how he's just, moving from side to side, backwards, forwards. He was focused.
All in.
And he's moving with the characters on the screen, and it was just funny. I mean, this went on for over 5 minutes that I was filming, and I showed it to him. He just started laughing. But they really, it's a technology that the younger generation really understands, and we don't.
This is funny, too, because we always talk about, all these jobs are going to be eliminated. Well, here's a job that we never even thought of.
Yeah.
Drone fighter pilots or something.
Yeah.
There's going to be tons of that stuff that's happening. But in all seriousness, we need to get ahead on that. I don't know where we are, obviously. I'm not certainly privy to whatever is the secret government plans, but we certainly need to be ahead on technology, or we could be in trouble.
Yeah.
So we're in the middle of December, kind of phasing out of 2024 and planning for 2025. So just a couple key takeaways if you have some downtime in December between all the holiday gatherings. But this is obviously a good time to revisit your budget, your expenses. I know we just talked about inflation, but it doesn't include food, and we all know food costs have gone up. But it doesn't hurt to have an idea of.
If you don't eat and you don't put gas in your car or anything, you're in good shape.
There you go. Don't do anything. You don't eat, don't survive. So this is a good time to revisit that. Sometimes people do all these things during when they get their tax documents, but I think the end of the year is always a good kind of look back of where you're at. Also, how is your emergency fund? So if you have some money set aside, or do you have enough money set aside for an emergency fund? We do know there was a lot of money over the last couple years in money markets and CDs, and we're starting now to see a shift with some of that money. So just making sure, if you have an addition to your emergency funds, how are you investing that money? Look at your debts. If you do have any debts, a lot of our clients pay off their credit cards and don't have a lot of credit card debts, but this is obviously a good time to see where you're at with your debt management. And then also kind of starting to think about next year, and if you have any new goals or any new trips or anything you want to do, and how does that tie into your financial plan. And it's also a good time to kind of revisit. It never hurts to revisit your asset allocation and your mix of investments between stocks and bonds and how you're allocated. Obviously, that's what we're here for. So we're happy to do any portfolio reviews during this time or at the beginning of the year. And then lastly, it's a good time to revisit your estate plan. If you have a trust or a will, your IRA beneficiaries, has anything changed in your lives? And obviously make sure that's all up to date. We actually just got a call this morning from a client that's making some changes to their estate plan. So we're here to help guide, and we had a conversation with our client and their estate planning attorney. So we're not estate planning attorneys, but we're here to help make sure that everything's set up properly for you. So never hurts to do some of these things. Some of these things we do year round, but also at the end of the year, as we're kind of looking into next year, this is a good time to look at some of these items.
It's a good time to look at your portfolio in general, and if you're not sure about where you're at, give us a holler. We'll be happy to help out. But right now, from what I can see, and I know, Vince, you probably say the same thing, that there's nothing on the horizon that we can see that looks really bad.
I agree with that. And you had mentioned nuclear, that we should be doing more in the nuclear space. And somebody was talking to me the other day. We were talking about artificial intelligence again, and everybody keeps talking about AI. And I just made mention to him. I said, because everybody, jumps into the same AI stocks. And I was saying, hey, listen, the thing about AI, it starts out where it's all about hardware and chips and data centers. All of a sudden, as you progress through AI, the big thing becomes power generation, number one. And number two, you really have to start focusing now on software and how it's going to run the AI platform. So I think hardware is going to take a bit of a back seat in 2025, and I think enterprise and different types of software companies are going to be the big beneficiaries of the AI boom and going
that looks
forward.
like it's already starting to happen.
Yeah, but I'm just saying, I think it's going to continue even further in 2025 because right now you're hearing that people have their chips in place, they have their data centers in place, they have servers in place. What they need is now software to run their mission critical company.
I know I have my chips in place so that I can watch the Bears play the Vikings this weekend, because we've got a big Vikings fan over here.
Yes, it's actually Monday night, so
Well, okay.
past the weekend.
Past the weekend.
Yes.
So maybe my chips aren't ready yet.
Means golf on Sunday instead of watching the game. One quick note on the year-end tax planning, like you were talking about, Catherine, is taxes. I guess Rachel's not here, so I'll talk a little bit about tax planning. There's a lot of different ways to be more tax efficient in your portfolios. There's tax efficient vehicles, like certain exchange traded funds are much more tax efficient than, say, open-end mutual funds. They don't pay a lot of capital gain distributions at the end of the year, so if you hold them for 5 or 10 years, you're not liable for any taxes during that time. But there's also positioning with your portfolios. When, depending on your makeup of your portfolio, you usually have stocks and bonds. If you have certain accounts available to you, it's more efficient to have your fixed income in a tax-deferred account like an IRA or maybe a 401k, where the earnings in there are always going to be taxed as income, whether you pull it out in retirement or if you have it in a taxable account, you're paying every year on that. So it's probably more efficient to keep those in the tax-deferred type of a wrapper if you can. Taxable event or taxable like stocks, if you hold them long term, you can get more preferential tax treatment. Long term gains for most of our clients is a lot lower, and there's certain strategies that large cap, say S&P 500 strategies now, that you can actually have what's called tax loss harvesting, essentially going almost every day, every week, every month throughout the year, where you don't have to do it. But the big firms out there, the Goldman Sachs, the Citigroups, things like that, they can help you grab losses throughout the year on the S&P 500, even in an up year, because all the stocks are, vacillating back and forth, up and down. Their computer programs can harvest those losses. What they do is, instead of buying the whole S&P 500, they just buy a subset of that that's very representative, has a very similar risk return profile. And so they won't own the whole S&P 500, but if, say, they own AT&T and that stock goes down one day or below where they purchased it whenever it was, they can harvest that, replace it immediately with, say, a Verizon, or a Citibank could be swapped for a Bank of America. And so I've been using these strategies for certain clients now for a couple of years, and the tax loss harvested that we've gained from that is pretty amazing. And we started, even in 22, we harvested a lot, 23, 24, and you can carry these losses forward essentially as long as you need them. You don't have to use them right away. So if you're interested in being more tax efficient with your portfolio, you know where to find us, WWM Financial, 760-692-5193.
I think that's 5190, isn't it?
Well, mine's 53.
There you go. You can call Greg. Nice.
Yeah. All right. Well, is there anything else that we want to talk about this week?
No.
Okay. What day is today? The 12th?
Today's the 12th.
All right. Yes. So there's only, I think, what?
One more. I think one more.
One more before Christmas, and then, right?
On into the new year.
Yep.
And then we're almost in the new year. It's hard to believe, huh? All right. Well, thank you very much for listening, and we'll see you again next week.
Thank you.
Thank you.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.